Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola, and Malaysian palm oil.
Paris Rapeseed. Since the low in mid-March, where we saw the market fall ending with a hammer pattern, we've seen a V-bottom and overall prices very gradually moving high in what could be seen as a possible ascending triangle pattern, or even an ascending wedge pattern. The lower trend line for both is the same. It is the bright red mid-March today uptrend, currently at 469 even. For the ascending wedge pattern, I've chosen not to draw a new trend line, but instead rely on two previously highlighted features. The flatlining until recently gold long moving average, currently at 495 and a quarter, and all the dark blue neckline extension, currently at 493 and a quarter. And that's to the April to August 2024 head and shoulders top. Over most mid-May, we've seen concerted attempts trying to break higher over both of these topside resistances, even managing a significant break higher over both of these last week. However, there were no closes over the gold long moving average, and the dark blue neckline extension and the declining gold mauve medium moving average, currently 487 and a half, they managed to have closed over, but they capped to market. Indeed, last week and this we have seen the prices testing the green short medium moving average below, currently at 479 and a half. Now, that all being said, the market is now entering a congestion area below, between the bright green neckline extension, which is currently at 480 and a quarter, and the 50% Fibonacci line of the May 23 to January 25 move at 467 and a quarter. I suspect we may be trying to work our way through this congestion zone below for a bit longer. Though, admittedly, today we are set up possibly for a daily key reversal up, but that will be very interesting, especially if we can get above the mauve medium moving average. Now, one final point, it may turn out to be key. Last week turned out to be a weekly key reversal down, though this week has only seen a small attempt lower. It's not been a major attempt lower as yet, though today is an interesting day. However, because we are still within last week's range, and it's the lower end of it mainly, which does help this pattern on the downside still a little. Winnipeg Canola. Back in March, the market halted its decline by a combination of the lows at 567, 571.80 and 575, plus the neckline extension, currently 545.30, of the April to June 23 reverse head and shoulders continuation pattern. I'd possibly also throw in the combination of the September 24 low and pipe bottom at 553.5 and the October 20 high at 552.80. Now, we didn't reach all of these back then, but the proximity and market actions on approach to these suggested a swift and immediate pullback up for prices. Now, please remember this idea of the neckline halting prices, as another neckline affecting the market will soon pop up again in my commentary. The recovery higher, though dramatic, initially had some issues. For instance, there was no weekly key reversal up, or even the lesser outside week opportunity here as seen in the other markets. The reason I gave back then, which still seems sound, was because the previously mentioned 50% absolute Fibonacci line that sat overhead back then at 606.90 and is now well below. Now, this does seem to put off initial attempts higher. However, as I said 9 weeks ago, and I quote, the action over the last 3 weeks, so that's over 12 weeks ago, does suggest a construction, or at least hints at the possible construction of ascending wedge pattern, possibly even an ascending triangle, end of quote. Well, prices shot up through the 50% absolute Fibonacci line 9 weeks ago, hesitating for a bit around the moving average congestion area, which was back then around the 2021 low at 629.60, before moving higher. To explain this move higher upwards, I spoke 8 weeks ago of the possibility here for a start of February being a bullish diving board pattern. However, I did add that the, and I quote, pattern here is very crude, with the run-in during February not looking very straightforward in my eyes. The plunge in early March looking good, but the recovery higher in later March looks indecisive at the start, though we've since become more determined, end of quote. Well, prices chose back then to continue their journey higher, making a significant moves up and over the February high, despite a ropey start. This is a better bullish diving board pattern seen here than elsewhere in the oilseeds and veg oils I cover. It nevertheless still ran into resistance at the February high at 682.20 and the earlier July 24 high at 685.30, but prices motored through higher. To give you some context to the move upwards, here is the data regarding diving board patterns. Nearly 9 out of 10 times the price rises as far as the bottom of the board. Now, this is, as I already said, not a good example of a diving board pattern here, but here I would regard that as being at about the 2021 low at 629.60, which we have seen. Quarter of them rise up within the diving board pattern itself, so between about 629.60 to the June 2021 low at 655.90, which we have also seen. Over 6 out of 10 times prices rise up over the diving board, so that is over 655.90, which we indeed have also seen here. In truth, we then started to run into some serious overhead resistances. Specifically, some resistance I mentioned 5 weeks ago, and I quote, "Some generated congestion roughly between 723.70 to 735.20, plus a recent ascending wedge lower trendline extension." End of quote. Now, I also added 3 weeks ago the neckline extension of the old August to October 24 reverse head and shoulders continuation pattern, which is 748.60. This one has been particularly good at capping the market, and the only reason I didn't mention it before is that I thought at the time the 623.70 to 635.20 congestion area overhead would have been enough. In the end, we had a gapping changeover lower 3 weeks ago, leading to what I can best describe as a somewhat artificial weekly key reversal down. Prices have since tried to recover, but the rise has been tempered as we approach the overhead 50% Fibonacci line, the July 23 to September 24 move at 750. And though starting to fill in the changeover gap, it seems that this week this had been too much. Just now, and we saw a sharp drop in prices earlier this week. The fall was interestingly only as far as the previous mid-May low at 664.10, which is coincident with the November 24 high, and the interesting 38.2% Fibonacci line of the same July 23 to September 24 move that the 50% Fibonacci line overhead had capped, plus the not insignificant rising green short medium moving average currently at 668.70. All these halted the decline this week, though I am watching with interest the green short medium moving average right now. So what have we growing here as a pattern? Well, I'm not too sure, but if I was to hazard a very outside, really outside idea, or ideas, then I would look at the action recently as a possible bearish cat's ears pattern. Or less outrageously, maybe a double bottom. More on these should they develop. Bursa Malaysia crude palm oil. Prices had over March and especially April broken down through some major structural supports that are now resistances. To start with, there is the neckline currently at 45.38 of the September to November 23 reverse head and shoulders pattern, which supported the market during March. 8 weeks ago, prices gapped below it. Next, and this one I had also commented on many times previously, is the neckline currently at 45.27 of the September 15 to November 17 head and shoulders top. I had not been too sure about this one in the past, but as it was an old one, a super old one that had before been way below the current market back in the day, well, similar to the earlier neckline, it started this year significantly supporting the market, so it was worth noting, though it also failed 8 weeks ago. The third pattern here is the now flatlining long moving average, currently at 43.93, that stopped the market's fall dead in mid-January and late March, but which failed also 8 weeks ago. There are also other newer, in some cases closer to the market features that helped hold up the market, but which have now given way. To start with, I look at the wide congestion area now overhead between 44.08 to 45.59. This is now resistance. Next, there's the significant combination of the 38.2% Fibonacci line of the May 20 to March 23 move and the 50% Fibonacci line of the May 23 to December 24 move. Both of these are at 42.74, plus the lesser Fibonacci line just below at 42.39. On these I said 7 weeks ago, and I quote, "It seems that some significant bearish pressure is meeting some quite substantial bullish supports. something has got to give, and for now it is looking like the downside might. If it does, then apart from the July 23 high at 41.89, we might not have anything of note below until the congestion starting at 40.26. Caution. End of quote. Well, 7 weeks ago we gapped lower and dropped down through that 40.26 zone, briefly trying to become an elastic move back up, trying to fill the gap left in behind, but failing to do so, and making another smaller gap lower 5 weeks ago, and down to and through the interesting dark blue neckline extension, currently at 38.82 of the small late May to April 2024 reverse head and shoulders bottom. I had said 6 weeks ago about this dark blue neckline, and I quote, "This is the one to watch on the downside. It is the core of the large April to September 24 congestion zone, stretching from roughly 3750 to 4100. End of quote. I also added 6 weeks ago, and I quote, "These actions have brought to my mind another newer pattern that may be just about completing, but which can even now still be derailed. Is to look at the whole move down from the high back in early December 24 to date. It's a really big halfway hesitation pattern. To give an idea of the potential on the downside, we have a possible target X down at 3750, right on the far end of the congestion we sit within right now." End of quote. Well, 3 weeks ago we reached down and achieved target X at 3750, even overshot it a bit. But we've had since then a reactionary move back up, such that the dark blue neckline extension is now a key support, resistance, and more likely actually a congestion point, all at the same time. We've since started to try and move higher with what looks right now like a possible ascending triangle pattern over May, and that's currently unhighlighted, but it's 38.45 to 39.84. But it is still a small pattern, and I don't wish to fully commit to this pattern idea just yet. I will maintain my peace on this market for now, other than to say watch this space, and especially watch the dark blue neckline and what it may do, and the small ascending triangle pattern. One final point, and it concerns last week's actions. I noted we had been set up for a possible weekly key reversal. However, we actually ended up with a lesser outside weak pattern instead.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.